Okay, folks, welcome back. ICT Mentorship, sell side of the market maker models, price action model number 7, universal trade plan. All right, price action model number 7, universal trade plan, sell side of the market maker models. Like you've seen in every previous trade plan, we have 5 stages to the trade plan. It's preparation, opportunity discovery, trade planning, trade execution, and finally trade management. All right, so we're going to be noting all medium and high impact events for the markets that you're following. You're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Okay, we're going to be preparing the ideas or trade idea with determining the IPTA data ranges over the last 20 trading days, but this asterisk next to 20 can represent the last 20 trade days, the last 40 trade days, or the last 60 trading days for the IPTA data range. Because it's a universal trade plan, we use all of those potential ranges, and we do not count Sundays. Note the highest high and the lowest low in the past 20, 40, or 60 trading days. This is your current dealing range. Inside this dealing range, we look for the next draw on liquidity. Where is price likely to trade to next? Below which old low? We look for a discount PD array in the direction of the weekly range bias. We anticipate price to move to a discount PD array that would support our weekly bias on a day and economic event found on the economic calendar with the current or next trading week. This volatility injection is what we wait for. This will be a run on basis of a low resistance liquidity run. Opportunity discovery. Identify a discount PD array below the market. That means wherever we're trading it now, wherever we're at market, below where that market price is, we're focusing on a specific price that we'll likely reach down to before completing a market maker sell model. We're going to wait for stage 1 or stage 2 redistribution periods to go short and target the terminus at the discount PD array. Identify a discount PD array, old low, below the market. That price will likely reach down to begin a market maker buy model. Wait for stage 1 or stage 2 redistribution periods to go short and target the terminus at the discount PD array. So what I've shown here is both selling short in a market maker sell model and now selling short on a market maker buy model. So we're focusing only on the side of the marketplace that is likely to drop. Trade planning. When the market is primed to drop lower, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely occur. We will short premium fair value gaps or short buy stops in a stage 1 or stage 2 redistribution. When we are bearish, we will frame a short entry when price has moved up into a 15-minute or 5-minute premium fair value gap PD array that converges with a standard deviation of no more than +3 standard deviation during London Open or New York Open. We can implement scalping protocols on this stage as well for further reduction in risk. When we are in the market maker buy model, we will target the sell side liquidity below the old lows at terminus. If we are in a market maker sell model, we will target the original consolidation of the market maker sell model. Trade executions. When we are bearish, we will anticipate a 5-minute chart institutional order flow entry drill trade entry to form inside of a retracement higher during London Open and or New York open kill zones, or a buy stop raid that we will go short when it unfolds. Short trade management. When we are entering a short, we will place a sell limit order on all positions we will execute in our demo account. We will use the standard deviation and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit order. When we are entering a short, we will place a limit order to take 20 pips as our objective on one position. We will place a second limit order to take 40 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 60 pip objective, close 80% of the trade and see if it has more to run. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 20 pips. We will re-enter if the trade stops out. We can monitor it for secondary entries. Day trades may require multiple attempts to secure a solid entry. Do not fear that. When we are in profit 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit 50% of our expected objective, stop loss can be reduced by 50%. When the position is at 75% of the expected profit objective, stop must be at break even. And like every other trade plan, you've seen these slides, but for the sake of completeness and drilling it home, money management, the position size calculation formula is your position size equals account equity times your risk percent divided by your stop loss in pips. Position size is the amount of leverage your trade or trades assume. Account equity is the total amount in your trading account. Risk percent is the percent of risk you are willing to take on per trade. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R percent or risk percent. An example, account equity at $20,000 US, risk per trade is 1.5%, or 20,000 times 1.5%, bringing us to a dollar amount of $300. Stop requires for this trade 20 pips. So in micro lots, that would be 1K each, or 10 cents per pip. 20 pips at 10 cents is $2 risked. $300 divided by $2 equals 150 micro lots per trade, or 1.5% of the account equity. Always round down. And again, the assumption here is we're going to be looking at mini lots. Same equity balance of 20,000, 1.5% risk. $300 is still the maximum amount of risk for the trade. 20 pips is the stop. In mini lots, that's 10,000 leverage each, and at $1 per pip. So 20 pips at $1 per pip, that's $20 risked. And $20 divided into $300 of the 1.5% equity risk divided by $20 gives us a maximum of 15 mini lots per trade, or 1.5% of the account equity. And again, always round down. And if you're going to be using standard lots, which I always tell everyone not to do because it doesn't give you that flexibility, but using a standard lot, which would be $10 per pip, 20 pips stop at $10 per pip is $200, and that can only allow you 1.5 standard lots, which you have to round down to 1 standard lot. So you can see the difficulty in framing your ideal risk management when using standard lots. Standard lots are not ideal for optimal risk management. If your demo account takes a loss on a trade and it is the full risk percent you assumed, drop that risk percent by 50% on your next trade when the loss is recovered by 50% of the initial loss. In other words, if you lost $300, if you make back $150, then you can go back to your original risk percent. You're then permitted to return to the maximum R percent per trade. However, if your reduced R percent trade assumes a loss, you reduce the R percent by 50% again, And you do this until the previous trade loss is recovered by 50%. This allows leveling in your drawdown versus just a roller coaster decline. If you take a series of 5 winning trades in a row, drop your risk percent by 50%. Now, the reason why is because you're likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. All right, start back testing. Now you're going to be collecting multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons on this price action model. I will provide sample sets, but do not rely or wait for mine. Dig into your charts and study what was provided here. Until I talk to you next time, I wish you good luck and good trading.